It's Monday and you're watching FreightWaves Now. I'm your host Anthony Smith, and coming up, Mike Baudendistel is going to give us a Rail Intermodal update. But first, we're going to go to Zach Strickland with Carrier Update, brought to you by PowerFleet. Stay tuned.
Hey everyone, and welcome to your Monday Carrier Update presented by PowerFleet. I'm Zach Strickland, and hopefully everybody had a great weekend coming out into a new week, recharged and ready to go. So looking at our outbound tender volume index, we've actually bounced off the bottom of some sort of floor. I'm not sure exactly which one, but it looks like we have bounced up a little bit. We were down around 8,400 last week, and now we're back up to 8,667. Now, is this super positive news? I don't think so, but it is good news in the sense that it does feel like we have at least started to really slow down significantly. We'll know more this week as the index, of course, a 7-day moving average, has to clear through some stuff. What we're seeing right here is the Good Friday impact. So typically about a 4 to 5% decline in volumes every year, in volumes on Good Friday, because people are taking more vacations and time off. It's not necessarily anything to get super excited about, but it is good news in the way that we do appear to have at least, you can see the deceleration here in terms of freight volumes. They are not dropping as precipitously as they were before. This time last year, this green line right here for the outbound tender volume index, we were seeing that Good Friday impact as volumes dropped about 4% right there, 4.5%, hitting that Good Friday number, dropping from about 9,900 to 9,516. So this is what we're seeing right here. Good Friday was earlier this year versus last year, so nothing to get super excited about yet, but this week it will be a pivotal week in knowing whether or not we are starting to bottom out, trough out, hit that freight market bottom in terms of volume. So we will look at capacity next. Outbound tender rejection index for the United States. Again, similar pattern here. Now this is a little bit more telling in the sense that this is showing some significant deceleration and dropping. We're asymptotically reaching this plane of existence where we are not necessarily, we're still dropping. We're still about 200 basis points down week over week, but we're not dropping as fast as we once were. 3.73%. Now, fun fact is that this is the lowest outbound tender rejection index value of all time since March 1st of 2018, the index's inception. So the previous low was 3.78% on August 13th. So we are getting close to the bottom on the tender rejection index, which means that rates should not fall super far. They should not be falling that much further than they are now. But again, tender rejection rates have an absolute floor of 0. So we can't get any lower than 0 here, but the fact that we are able to at least maintain some semblance of a deceleration in the rate is important. So capacity not declining as much. Looking at the biggest markets in the United States on our volatility map here, you can see there's not as much red on the map as there was before for the outbound reject volatility or outbound volume volatility. So good news there in the way that we're not seeing as many strong decreases on the rejections. Obviously, the tender rejection index showing that outbound volume volatility for the biggest markets in the United States, Atlanta, Ontario, Dallas, Harrisburg, all actually doing just fine. We're still dropping in volume, but statistically speaking, we're not dropping as fast as we were. We actually have a moderate increase in the Dallas market in terms of volume. Over here, it's going to be the tender rejections on the map. So anything showing strong to moderate decreases scattered throughout the middle of the country, largely a lot of low volume markets there, not a lot to get super excited about. We all know tender rejection rates week over week have come down quite a bit. So, but still, we are seeing much less red on this map than we did this time last week. Here is the head haul map excluding 100 miles. So the reason I'm going to pull this up real fast to set you on your way for the week is the fact that this is going to be the stat that we're going to watch here as the market comes back online or starts to slow down or whatever it is that it decides to do, as market balance becomes increasingly important for you carriers out there that are trying to figure out which markets are going to be better for me to enter moving forward, because they're going to have a lot more outbound freight than inbound freight or vice versa. The Phoenix market down there leading the charge charge on the backhaul markets at a -75. Up here we got Allentown at 62, and there's the Dallas market right here with a 53.22, but 144% change week over week. So again, Dallas market looking pretty good. And that'll do it for today's Carrier Update.
The comprehensive logistics offerings from PowerFleet cover in-cab ELD, fleet management, trailer tracking, cargo monitoring, and tracking other assets such as chassis and intermodal containers. Power up your operations with PowerFleet.
Welcome to your Rail and Intermodal update. I'm here with Mike Baudendistel. Mike, what's the latest?
The latest is Kansas City Southern reported on Friday morning and really had what I thought was really impressive results. They had an operating ratio below 60%, 59.7 on an adjusted basis. So that was a level that a lot of people not too long ago thought that Kansas City Southern couldn't get to with their north-south orientation from the U.S. to Mexico. And so it really shows that even though volumes are way off, revenue growth is taking a step back, it's really not impacting their ability to streamline their cost structure and just make it a much more efficient operation. So that 60% was a really impressive number. They also talked about how their cost structure is about 60% either variable or semi-variable. So I think that's something we're going to hear a lot from the other railroads, that are mostly reporting later this week, is talking about how much of their costs are variable. I think my favorite quote from the Kansas City Southern, report that they had their analyst call was that they had not even thought about cutting their dividend. So the railroads are in a much stronger place than they were in, say, 2008 and into 2009. And actually, I thought they handled that situation, well with reducing costs. What we have on this board is total carloads for the U.S. and total carloads in Mexico. And you do see over the last year, Mexico has outperformed the U.S. Would attribute that to a lot of the chemicals and petroleum volume, Mexico energy reform, those type of things. One thing that stood out from Kansas City Southern is that the area that had the most revenue growth, most volume growth, was carloads that are petroleum and chemical carloads. Those have very high revenue per unit metrics. So they did have a positive mix impact. If you shift over to intermodal containers, comparing the U.S. to Mexico, it's a little bit of a different story where Mexico has fallen off further. A couple of reasons for that. One is that the weakness of the peso makes it difficult to compete with trucking companies down into Mexico. Kansas City Southern doesn't want to reduce their revenue or to reduce their price because it's hard to get it back. So they lose out some market share there to truckers down there as well, and then also some slowness at the ports of Lázaro and those things.
Right. And so it sounds like the big takeaway from Kansas City Southern is cost structure really being impactful for those OR numbers. And so, as you said, you think this is going to be a common theme in the coming weeks when you hear other reports? Yeah,
I think so. And really this sort of illustrates it here, too. I mean, this is the employment for the railroads. And you see really over the course of 2019, employment on the U.S. railroads has declined faster than rail traffic was down in 2019. Now, 2019, rail traffic was down about 5%. For most of the U.S. rails, the employment was down significantly more than that. Union Pacific was down, double digits in the fourth quarter. So, I think we're going to see more of that, and it's going to be the rails are going to talk a lot about how well capitalized they are, their interest coverage, and those type of metrics, which they're all in pretty good shape there. Right,
right. And any expectations for some of the releases coming up in the coming week?
Some of the earnings reports coming out in the coming week. Right. I think they're all going to take away their guidance. I think they're all going to sort of suspend their guidance. I think a lot are going to say that they're going to suspend their share repurchase program just to take have a tighter control on their cash. But I'm going to say that they're going to say the dividend is safe. There won't be any touching to the dividend, and they'll talk about how variable their cost structures are, and it's more variable cost than people would associate with sort of a network business like a railroad. And with Kansas City Southern specifically, they talked a lot about building longer and heavier trains. So lower volume is leading to fewer train starts, but those starts that do take place, they're maybe delayed a little bit, but longer and heavier. So you're actually getting some efficiencies there.
Got you. Mike, thank you so much. Insightful as always, and thank you so much for tuning in. That's going to do for this Rail Intermodal update, and that's also going to do for this edition of FreightWaves Now, but the content doesn't stop here. We're always streaming around the clock, so check out our FreightWaves TV app and all your favorite streaming platforms, including Apple TV. Thank you so much for tuning in, and we'll see you on the next episode.